the stream comes through good, which I think it's going to in a second here. But I think this way everybody's going to hear Powell a little bit better, so I don't have to do all sorts of nonsense. But let's see if this stream starts to populate here, which I think it is about to. Let's see. Give it a minute. Give it a minute. We should be good. I hit go live. I don't know why we're not live yet. Are we good? We're all right. So, ladies and gentlemen, welcome, welcome, welcome. All right. So, I hope everybody is having a good day and has done absolutely nothing today, which is what everybody should have been doing, which is why we didn't do the stream this morning. So we're going to be getting the interest rate decision. We're going to see the dot plot. We're going to see a lot. We're going to be getting so much data today, guys. There's going to be a lot to break down. So I hope you guys are ready for this. Market's selling off going into FOMC. There's a couple of things that we should realize here. One, if you've been paying attention to all of the YouTube videos, which I hope all of you guys have been, because those videos, guys, and that information in them, you're not going to see that stuff anywhere else. Most of the YouTube videos out on the internet are really just filled with filler fluff. It's a title, a thumbnail, and then it's just like, all right, lead you through and you don't get anything out of it. But hopefully with what you guys have been seeing with the GDP projections moving down, unemployment moving up, inflation starting to move back to the downside, and especially with this new administration coming in and not going to be providing that crutch to the economy and the markets that prior administrations have had, you could easily see that growth slowdown coming in the near future. And then you also have to tack on top of that all of the debt that's going to be refinanced, rolled over this year, and that's going to add to the interest expense. So there's going to need to be a balancing act here throughout really the next year and a half that this market and the overall economy is going to have to start to get used to. Now, what are the tools at the disposal of, let's say, the Federal Reserve in order to counteract some of this growth here? And again, guys, as you guys are filtering in, make sure you guys are hitting that like button. Costs you nothing to do it, but it helps me out a whole lot spreading these streams out to as many people who actually want to learn. You guys are slacking. Let's do the 150 like threshold again. That's what we do on Fridays usually, but we'll do it today on an FOMC day. Let's see if you guys can hit that like button, get it to 150. But what I want to bring your guys' attention to is this. We've talked about this in the YouTube videos, and again, hopefully you guys have been paying attention. The volatility in markets that we've seen really over the last 3.5 months here, it really started at that hawkish cut in December. So in order for money to start flowing back into markets in a very significant way, even though we have tariff stuff and all that, but again, it's not the short-term effects of the tariffs to me, and I've said this many, many times, are pretty much irrelevant. The market's selling off like this. I really personally do not think that tariffs are driving this whole move to the downside. It has a lot to do with growth prospects moving forward. And the market coming to the realization that they're not going to have that crush from the federal government coming in and backstopping everything with all of the increased government spending, the government hiring. Again, Bank of America says that it was 85% of all job growth last year was from the government. That's including a lot of different things. It's usually like 30-ish, but that's still significant and can definitely create a drag on NFP, non-farm payrolls, and increase the unemployment rate. So, but the thing to realize here, guys, is that Powell and Trump don't really like each other, and it's possible that we get into a situation like 2019 where they kind of start going back and forth here. If Powell does not come out with a dovish tone today, you're going to see some Trump tweets. You really are, because the main goal of this administration is to get rates down. It's not, they don't care about the market right now. The market is going to come back up once they get their entire plan that they want to accomplish enacted, and that's going to take time to do. They don't care about the market in the short term. The first step is getting rates lower. Now, Powell can actually come in and completely throw a whole wrench in that if they maintain their I don't want to say super hawkish, but relatively hawkish stance today. Some of the questions that, again, we're going to need to really pay attention to here is a question on that Atlanta, what is it? Fed now, GDP estimate, whatever it is. Absolutely collapsing. They're going to talk about maybe trueflation, but again, the Fed doesn't really like to use trueflation. They like PCE, but the PCE estimates are pretty low. They're going to ask about the unemployment rate ticking up. Those are going to be some interesting responses. Like, it is possible that their statement comes out as a little bit hawkish and they kind of stick to their guns, but then in the actual Q&A from Powell, he kind of hints at, like, all right, we're probably going to come back and capitulate a little bit. So Trump is going to tweet no matter how dovish Powell is if he doesn't drop rates. Well, yeah, I wouldn't say. I mean, you can't really cut rates right now. It's not something that you can that I would say is justified. What I would say is May is the earliest. June is the prevailing expectation right now, which is probably when it's going to happen. But remember, guys, if you guys were in the Discord and you guys were reading through that big 2025 macro research report, what did I say? 10-year Treasury yields by year end are probably going to be a lot lower than they were now, and that was at 4.6. So it actually was pretty close to the top there. I mean, I was calling this on Twitter. It was on this day that I was saying, all right, it's time to start looking for a top in the 10-year. So I wasn't on the day. I was a day early, 2 days early, whatever, this time. It's not like I'm going to bottom ticket the exact day like I did here on the day before the September cut. Like, I'm going to get really close every time, but I'm not, again, don't expect me to nail it like that every single time. But Trump is going to Trump. No, I know. He might. I mean, we'll see. It'll be interesting to see if he starts firing off tweets during the presser. And then they ask him a question about the tweets being fired off in the presser, which would be hilarious. But we'll see, guys. Again, make sure you guys are hitting that like button on the way in. Costs you nothing to do it. Helps me out a whole lot spreading these streams out here. I think the main thing, though, guys, for all of you guys that are watching the stream right now, make sure that you guys go down and check right now. Just check that you have notifications turned on for the YouTube channel. I'm going to be posting a lot more YouTube content. I have something really awesome coming for a lot of you guys here that are going to be very, very interested in. I mean, I know a lot of you guys really like to hear my macro takes. A lot of the single stock stuff that we do. I mean, last year, Palantir at 15, SoFi at 655, Yin at 20, Philip Morris at 95. And now NEO at 454, which in my opinion is the riskiest one that we've looked at. RKT as well. That was another really great one, buying that sub 12. So I'm going to have some really fun stuff for you guys there, but make sure that you guys have notifications turned on for the channel and don't miss any of the videos. I don't make the videos for my health, guys. I make them for you guys. Okay, so it's the same as always, guys, with the FOMC meeting. The interest rate decision, I think we get an SCP today too, don't we? Summary of Economic Projections. I think we do. So it's 2 p.m. is the interest rate decision and the prepared remarks, and then 2:30 p.m. is the press conference. I think we get an SCP today, but I'm pretty sure. When was the last one? I think it was December. Yeah, I think we do. I'm pretty sure we do. Thank you for making the videos. Yeah, no problem, guys. Hopefully you guys are enjoying them. I don't make them for my health. Like, it's so that the main reason I started this channel in the first place is, like, because so much content out there, guys, is just such nonsense. Like, nobody really knows what they're talking about. And I know a lot of people will look at me and be like, oh, the young guy on YouTube, what does he know? And it's like, guys, I've been doing this since I was 14, learning from some of the most successful financial professionals in the world. Like, that's why I can sit here and just talk about this stuff and, like, nail tops and bottoms in the bond market and help you guys understand everything that's going on. So, again, make sure you guys are checking to see if you have notifications on, and then like the video. That's it. Bob is screwing out. Oh, also, AMD, guys, that was just rude. I can't believe they caught us here on the base rate. It's still setting up. I think AMD is going to give us another opportunity unless Powell comes out a little bit dovish and then the market rips, which that's fine. There's going to be a lot more opportunities that are going to come along with that type of move. I would say, I see you're asking about the bottom dropping out of the market here. So it's possible. Again, it really depends on what happens here with the tone of Powell. The thing I would say, though, that would give the bulls a decent argument is that if you look at this, it's kind of hard to see here because we've been going straight down, but this break right here in the close above, 563.80, right around there, is a little shift of trend, and you've now made a higher low. So that's on the bulls side for the start of maybe a little uptrend, but that doesn't mean that this can't bear flag, and then on April 2nd, when the more tariff stuff comes out, the market doesn't sell right back off. So, but I would say, I mean, that's on the bulls side there. You did see volume pick up at the lows a little bit, so we'll see. We'll see what happens, guys. You're still inside? You're still inside what? Yeah, I mean, I was sticking to exactly what the plan was with that one. I could have held it and just slung it there a little and just said, all right, the contracts were for June, just let it go. But, like, I'm really not. Like, I don't care. Remember, I still own a boatload of shares of this thing. So if it's going to run a little bit, obviously the position is drawn down. But, like, my basis is zero. It's free. I own AMD at $11.39, guys. What do you think I was doing when it was up at 200? Oh, Mario's still in it. Oh, there you go. So, okay, Mario, here's the thing. I know that you were looking at the Lockheed trade that I gave you guys, which was nasty. This one. And you got weirded out on these days in here. But, like, my plan always stays the same. You see this alert right here? It never came down and hit the breakout days low, so I don't touch it. AMD did. That's why I cut it. But that contract was down, like, I don't know, 15%? 20%? When all my winners are 100, 200, 300, 400%, guys, the outcome of one individual trade to me is literally meaningless. I don't care. And that's why operating in the market this way, focusing on swing trading over day trading, which I know a lot of you guys still do. Don't know why you still do that. It's so wild that people do that. And they're just, like, scalping low time frames with, like, no edge. And they're like, oh, this is going to work. It's like, nah, good luck with that. So... yeah, we'll see. I mean, it's been a slow market for the last couple of weeks there, but there's been some really awesome trades. I mean, you guys remember the McDonald's epic one, EA, Lockheed. I think you guys nailed Lockheed and EA for 1,000%, or something like that. There's been like 7 multi-1,000% trades I've given you guys in the Discord over the last month. So yeah, congratulations everybody. I mean, if you guys do want to hop in there with us, the link's at the top of the live chat. You get your first month for 50% off with code TRADE. You get all the educational courses, both of them, the pre-market plans, the private live streams, the full watch list of stocks and cryptos that are about to explode before they do, the macro research reports, single stock research reports, everything. So, I mean, on there, you can just click that link, read the reviews. I don't have only 5-star reviews for no reason. So, yeah, we'll see. I mean, Bob is screwing around. Crowd looks good. That's the weekly. Don't care about the weekly right now. Crowd looks fun. All right. So we've got what? 18 minutes to go here. LMT over the next 3 months. Not really looking at it. I mean, you are in a little uptrend here, but we've already done our dirty work on this thing. Caught the break here. This was a nasty, like, this is exactly what I'm looking for. Like, when you get these nice continued moves, you don't need very many of these in a year to absolutely crush it. You got how much shares you're holding until we get news series ceasefire stoppage of the war? Well, I mean, I don't know. If you weren't taking profits over here at like 480 and then at the next level that I gave you guys, which was 493, I don't know why you're still in it. If you like it for the long term, if you got the entry down here, I really don't hate that. That's fine. That's a great base. You guys know I like to buy bases, which is why, like, I'm able to get these great risk to reward entries all the time on the mid to long term stuff, because it's a 3-pronged approach. It's, you got to understand the big picture. So the China one was a great example. So if you look at yin, I'll show you guys where I bought yin last April. So yin is now back up to where I sold it, and I was buying it. Well, I was buying it in here at 20-ish, and then sold it at 51. But if you look at this on the weekly, I'm not going to go through the whole China thesis because we've done it too many times, and it's in a bunch of videos, and it's too long to go through right now. But if you look at this on the weekly chart right here, this is perfect. It's a perfect weekly breakout, even though it came back down, and I think it actually went red for a second there. Yeah, for a week. The thesis stayed the same, so there was no reason for me to sell this thing. It ran up to 51, sold half. Now I have free exposure to China. Thanks. And it's levered. Ooh, what a trade there. So we'll see what we get here today, guys. It's really gonna depend on the tone of Powell. So I already have a video idea for today. I'm trying to get 2 YouTube videos out for you guys every single day. Not Fridays. That's crazy. But today I already have a good video idea, so we're probably not going to recap this. But on the Discord stream tomorrow, we're obviously going to be talking about what Powell said. BBAI, I could take a look at it, but it's probably not something that I'm going to be overly interested in. No, I don't like this. You're just trying to catch a falling knife here. If you were to force me to take a trade on this thing, I'd say short. This does not look good. Dipping down below the 200. That does not look good. So, all right, guys. We'll see what we get here. Market's flying around going into Powell. Again. Oh, you guys are slacking on the like button today. Uh-oh. Uh-oh. You guys are slacking hard. Uh-oh. We have 150 like goal, guys. All you got to do. Costs you nothing to do it. Hit the like button. Come on. Come on. Do it. It'll make me happy. All right, let's see. Yields have just been waiting for Powell, dude. Just over the last, like, 5 days here. It's just been waiting. What's Powell gonna say? Trump is gonna rip the you-know-what out of the market. Guys, all right, we can talk about this too. You guys are, a lot of people are blaming Trump for the market coming down, but like you then, like, yes, okay, yes. The new administration and the way that they're running things is causing the market to sell off. But the thing that I think people just are failing to realize that if we kept going on that trajectory that we were going on, we had a literal ticking time bomb. Like if you continue to just rampantly spend money and artificially prop up the economy through all of this government spending, there's going to come a time, which this is what I was talking about before. It's the new, all right, this is a better way to describe it. Think about a situation where you're in a car, you can't get out of it, and you're speeding towards an immovable object, but you don't know how far away it is. With going with the status quo, with the way that everything has been done in the past, you were probably going to hit it soon. You're going to hit something, depending on how long they could prop it up for. You're going to smash into that immovable object, and things are going to go poorly. At least in this example, we're slowing down the car a little bit. You're buying time. You're saying, okay, we're going to decrease government spending. We're not going to have all this bloat in the government. Like, I just don't think a lot of people understand the statistics that like a third of GDP every single year comes from government spending, and a significant amount of job growth every single year comes from just the government sector. But that's not real. Like the spending by the government is literally just debt. That's all it is. So then when you think about the debt problems that the United States already has, is that a good thing or a bad thing if it continues to go on the trajectory it's on? Well, obviously that's a bad thing because interest rates are going to continue to go high as people don't necessarily have as much faith in the credit of the United States government because they're making bad financial decisions. So what happens? Interest rates go up. It causes this massive debt spiral and interest payments go through the roof. It then causes you, the everyday person, to have way higher mortgage rates. You can't buy a car. Student loan rates go through the roof, and you get absolutely screwed. Everybody on variable rate loans or floating rates in that scenario gets wiped out, and you have one of the biggest financial crashes probably since the Great Depression. So when you think about it, it's like, okay, yeah, you might see a little bit of like turmoil in the present, but like to me, it's like it may not work. What they're trying to do, it may not work. They might completely screw it up. But you have to try something. You can't just it's better to try than it is to just continue basically shooting yourself up with drugs. You know? So people can say, oh, they're tanking the market. And it's like, all right, so for everybody that's just a normal everyday person, don't you want all the assets? Like, the logic doesn't make sense because they're like, oh, yeah, we want, like, first of all, if you don't have any assets, it's a good dip to, like, it could be a decent dip to buy. And then second of all, like, the people that are going to get hurt from this are really, like, the top, like, I don't know, 30% or 10%. So, like, you're kind of getting what you wanted anyway with this decent drawdown in the market, even though it's really not that big. So, I don't know. I would say it's kind of necessary. Everything that's happening. Is, like, completely pissing off your neighbors the best way to do it? I don't know. But the problem is that if everybody and their mother thinks that Trump's, like, tariff policy, and we're talking a lot of macro here, but this isn't, like, political. I don't want anybody to think I'm being political. Like, if you guys, like, you can refute anything that I'm saying here. I'm trying not to go into anything political. Like, actual, like, opinionated stuff. Like, if everybody thinks that like, this is game theory, but if you just think that the tariffs are just a bargaining chip and everybody knows that, then the actual effect of threatening them is actually meaningless. You kind of have to follow through on some of them in order to, you know, like, give STV a like. I would appreciate it, guys. Keep smacking that like button on the way in. I'd help out a whole lot spreading these streams out here. We're trying to hit 100K subs on YouTube. I think the goal is by my birthday, but I don't think we're going to be able to do that unless we really start cranking on YouTube. So, we'll see. I think we can do it. We've done it before. We can do it again. I think the quality of the video speaks for themselves. But we'll see. Yeah, I'm going to... So, it might take a second for me to get the Powell audio at 2:30. Just because, like, we're doing this a little bit of a different way. I'm not using Restream for this. So, I think it'll work. Because I've used this before. So, I think it'll work. So, we'll see. 150 likes on the stream is the goal. Let's see if we can do it. So, but yeah, that's kind of everything that we're looking for going into Powell. Obviously, Trump and Powell do not like each other. We easily could see some volatile tweets moving markets around based off of that. But again, guys, that less trades, more profits methodology that I just harp on with you guys all the time in the group is just like, it's so critically important. Like, people will come in and they'll be like, oh, I thought we were going to be trading all the time. It's like, you joined a group called Less Trades, More Profits. Like, why do you think the most successful traders or investors of all time don't trade all the time? It's because they're looking for really, really solid opportunities and then smacking them. And that's what I like to do. It, like, because you don't... People think about the market like a school or their job, and it's like, oh, we have to show up every single day and perform XYZ tasks in order to feel productive or to move forward. Trading's the opposite. You got to unlearn that. If you're going to be in the market at all, you cannot operate like that because it's a great way to completely blow your account up. It just, like, lose all of your money. You can't do that. You're the only one talking about how basically we were lied to and about how good the economy was because it's really just the government propping it up. I mean, guys, you guys heard my rants last year about the jobs data where, like, I was going crazy on the streams here. I think a lot of them were the private streams with you guys, but I was going nuts. I was like, guys, this data is not true. It's a lie. Or even if it wasn't like a blatant lie, which it was because they revised them a lot lower, it was just artificially manipulated because you can't say that all of these okay, first of all, the way to explain this is part-time employment is counted in. So, like, if you have if you have two jobs, you might get counted in there too. But also, let's say undocumented people were counted in it as well. And then you just had, like, I've shown you guys in the videos many times in Q3 of 24, they said that your real wages grew at 1.6%. And this is where it's like, to me, it's crazy because you'll sit there and you'll see these people that are talking and they'll be like, nah, shut up. The data says that you're fine. We're not going to do anything to help you because, one, your real wages are growing and everything's fine. But then 5 months later, it comes out that that wasn't true. So you had 5 months of, like, you could have helped people, and then all of a sudden it's like, whoops. Like, they said your wages were real, like, net of inflation, were growing at 1.6%, but they were actually down 0.1%. Oops. My bad. So, I mean, again, the other problem with it, too, is that now that the data is coming out, you might see, like, I don't want to say the real data, but, like, data that's going to come out that doesn't need to be significantly revised, which will definitely screw around with markets a lot. So, actually, where's AMD now? How's that looking? It's still chilling above 105. Yeah, but we've been talking about this for a long time. And the China thesis. The China thesis I had a lot prior, but, like, shout out to David Nikoski. If you guys aren't following him on Twitter, which we're going to do something here, you guys should. I don't know why you don't. He's like he's like the only person that I've seen talk about all of last year, the dollar and the rotation out of U.S. assets. So here you go. Make sure you guys follow that Twitter account there. But, like, and what are you seeing this year? European markets are outperforming. Chinese markets are outperforming. Mexico's markets are outperforming. I believe some markets in South America are outperforming too. There it is. David is, man. David's awesome. Yeah, it's it's infuriating for us because we'll sit here and be like, oh god, like when they inflated the jobs by 180K. Yes. They lied. They said there were 180,000 more jobs than there actually were. Or I don't know what the exact, it might have been 180. But it was pretty ridiculous what they were doing, guys. So I mean, that's just like macro rants. I mean, we've got 5 minutes until the interest rate decision, which is, I would say, 99.99% probability of no movement, no up, no down. The contents of the prepared remarks are going to be incredibly important to understand the tone and the positioning shifts, if any, that the Federal Reserve has taken. So are they going to move towards... Okay, so I don't want to... Sometimes I feel like I do this, but usually I feel like I do a good job of breaking down stuff simply. When I say dovish or hawkish, it basically means the Fed is going to be more, and on the dovish side, more accommodative, loosening financial conditions, meaning more open to cutting rates. The hawkish side is the exact opposite. They want to have stricter financial conditions. They're more, they want to sit back a little bit, watch the data, wait, maybe more open to raising rates, which they're not, but does that make sense? And again, if you guys have questions on anything, just ask. That's what I'm here for. Don't message me on Discord, though, ever. I won't answer. Unless, well, no, I won't answer. If you guys ever have questions, just message me on Instagram or Twitter. There's too many scam accounts in just Discord in general. That's why I'm like, no matter what, I just won't use it. So, like, if you get messaged by an SCV account, you know it's not me because I don't use Discord DMs. So YOLO memes. Well, I mean, if you look at the, I don't want to say yes, because like, no, that's stupid. But if you think about like small caps and stuff, like the dollar movement to the downside here is interesting. If money starts flowing back into the United States, like this move here, a lot of people on Twitter were talking about how like this was going to be good for small caps. It's not, because the context of the move is important. This is money flying out of the United States at the start of 2025. And going into other markets, which is why you're seeing those markets outperform. They waited too long to become hawkish. Let's see. Bro, 3 minutes! Focus! Dude, you do realize that I have the news feed, and once it comes out, we're just gonna have it all. In like 2 seconds. Like, they're not gonna, you're gonna see everything move around. If you're sitting here thinking to yourself, oh my god, I want this guy to tell me what to buy or sell right now so I can make money today, go somewhere else. You're just gonna lose money. Don't do that. It's not what my group's about. It's not what anything should be about in the market. What are the two important moves? I just use the 10 and the 200. I rarely use the 200 unless things are sitting right next to it. The 10's really all you need. But again, Survive and Thrive, once you hop into the Discord and you go through all the educational courses, the main feedback that I get is, oh my god, why wasn't I doing this sooner? This is so simple. And it's like, yeah, I don't know why everybody loves to try and scalp the 15-second time frame with no edge and lose all their money. You guys are like, what is it called when you, like, is it like you like to get beat up or something? Masochist, is that the word? That's most of you guys. You're like, I want to go lose money. And it's like, but you could just go make money. You could, if you want to. So, all right, let's see what happens. We got a minute. 57 seconds here, ladies and gentlemen. It's the most important Fed meeting of our lifetime until the next one. All right, is it two? It's, what do you call it? The interest rate decision comes out at 2, so in 45 seconds with the prepared remarks. So we're going to be breaking those down. And then the, what do you call it? The Q&A is at 2:30. So, again, keep smacking that like button on the way in, team. Costs you nothing to do it. Helps me out a whole lot, spreading these streams out. See what we get, folks. 5, 4, 3, 2, 1. Crazy candle coming. Or a dud, which would be hilarious. Huh? 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 All right, let's see what's hitting the feed. Fed holds rates steady. This is from Nikki Leaks. Median of the rate cut forecasts are unchanged. Ooh, that's interesting that the market's popping on that. Are unchanged from December, still at a 2-cut median. The Fed slows Treasury runoff QT to $5 billion per month, so they're slowing down quantitative tightening, which is interesting. Ooh, Chris Waller dissents on the QT decision. Very interesting. So there was a dissent there. Ah, this is getting interesting. Oh, here we go. This is why. All right, ready? Fed sharply reduces 2025 growth. Why are they stupid? Oh my God, I'm gonna lose my mind. I swear to God, I can't with these people sometimes. The market's gonna call its bluff, but like the fact that we have the Fed saying this is just ridiculous. The Fed sharply reduces 2025 growth projection, marks up inflation. That's them signaling stagflation. Stop doing that. Japan was last night, I think. That's ridiculous. They're like signaling stagflation. Kind of. Fed says uncertainty around economic outlook has increased. Yeah, to you. Yeah, to you guys, you PhDs reading your textbook saying that tariffs are going to be super inflationary while discounting the fact, like I said earlier, discounting the fact that we have a new administration that's not going to be spending, not going to be adding all these jobs. You can't, I can't believe they're sticking to this. That's crazy. Economy expanding at a solid pace, labor market stable, inflation still elevated, to slow balance sheet runoff starting in April. That's interesting. That's probably why the market got a little boost there. Cutting a monthly treasury redemption cap from $5 billion to $5 billion from $25 billion. One dissent from Governor Waller opposing balance sheet adjustment. So right now it's a dud. Right now this is a dud, ladies and gentlemen. But I think it's absolutely insane and wildly irresponsible that they are marking up their inflation expectations. Are you nuts? What are you looking at? I seriously want them to explain that. What are you looking at? I don't understand that one. Yeah, well, Japan didn't do anything last night, so no real change there. Crowd shot up a little. What else? Did AMD... Nothing hit alerts here, which is interesting. AMD moving up. Bobbing nothing, so China's not moving. Yeah, I mean, I think the Fed, at this point, I think can talk all they want about their inflation outlook moving to the upside, but I don't think the market's going to care. So they're going to look at growth slowing, and they're going to focus in on that and say, okay, well, if you expect growth to slow when we have a good understanding of inflation probably moving to the downside, and the risks are actually to the downside, not to the upside, then that's what the market's going to focus in on and probably still stick to their guns. That actually, this will be interesting to see. What did Fed Watch Tool move to? I want to see May first. May went down. June actually went down for first cut, but still over 50%. And then December is really what I'm focused on. They're kind of pricing it in 2 cuts here for the year. What is the bond market doing? That's interesting. They bought bonds on that. Look, that's interesting that they bought bonds on that. Yeah, the market's calling it the Fed's bluff here. For now, that's what it looks like. Because think about it. If the market believed the Fed and was focused in on their inflation expectations, this move would be the exact opposite. Because if you think that the value of the dollar is going to continuously deteriorate and inflation is going to continue to maintain at its elevated level or even go up, if the risks that they're saying to inflation are elevated, well, then you're going to require a higher rate of return on your government bonds. So you'd sell government bonds and you'd wait for the yields to go higher, but that's not what you're seeing. So, we'll see. This is a dud of a meeting right now. Let's see what else is coming through the feed. And then we have the presser at, what do you call it? 2:30, which will be very interesting. Hold on. All right, so this is kind of interesting. So I think this is really from the SEP. Fed cuts 2025 growth projection to 1.7% from 2.1 in December. So growth expectations are lower. The unemployment forecast went from 4.3% to 4.4%. So unemployment is looking to go up. And they raised the PCE inflation forecast from... yeah, they're kind of signaling stagflation. Core PCE to 2.8 from 2.5, but like I don't believe them. Why would I? What out there in the marketplace right now is signaling to us that inflation is going to be a lot higher than everybody is thinking? What's there? The only thing that I can really say is, oh, look, the textbook says tariffs are inflationary. And you guys all know how I feel about the textbook. You also say the first reaction is normally long. I don't really say that. That's just a thing that people say about the FOMC move. The first reaction was down, but... so we'll see what happens in the presser, but usually I blow a gasket when they start saying stupid things like this. Like, that was just silly. Even when Powell was interviewed 3 weeks ago, he emphasized the word tariffs like he said it. Yeah, I mean, they're being overly political, and I think that's going to be a very big mistake for them. Because what happens when unemployment continues to go up and growth continues to slow down in the short term? And then inflation as a result of that moves down because the demand side pressures are moving down. And then also you have consumer sentiment moving down, so the consumer is not doing well. And if the consumer doesn't think that they're going to do well, they're not going to spend money, which is, again, going to limit growth. The only thing is... and I said this in a tweet, and I made a video about this. It was quick. It was like an Instagram reel or a YouTube short. On those one-year inflation expectations, if you break it down by political party, it's the wildest chart of all time. It's like Republicans think that one-year inflation is going to be 0.1%. That's not true. Independents thought like 4.5, I think, which is also not going to happen. And then Democrats thought like 6.5%. So the average came out at like 4.9. For one-year inflation expectations, which is dumb. Like, that's just, stop watching so much TV, guys. It's making you, and that's what I said. It's like you're listening to the TV and saying, oh, person on the TV says that inflation is going to go up, so that's what I think now. It's like, no. They're most of the time wrong. It's like saying, oh, I'm going to go listen to Kramer on all of his investment advice. It's like, all right, good luck with that. Well, how do you think that's going to go? Not well. So, the one thing is, though, is that sometimes those inflation expectations can be a self-fulfilling prophecy. There's two main things that can happen. It can increase spending in the present. So if somebody needs to make a purchase on something, whether it be big, small, they might do that purchase now because they think the price of that good is going to go up in the future. So it can spur a little bit of growth. But if consumer sentiment is already really low, they might just forego that purchase altogether and be like, meh, I didn't really need it. The second thing that they do is they go to their employer. Think about if you're a rational thinking person and you think you really wholeheartedly believe that the prices of things are going to be up significantly in the near future. You're going to ask for a raise. Okay, so the employer can either give you that raise and their margins shrink because, again, with sentiment already low, the demand for their products at those higher prices is going to drop significantly. So then their margins shrink and their earnings go down and then limits growth. Again, GDP down. Or you have the companies say, you know, we could be a lot more efficient here. A lot of people are asking for more money, and we don't really need to pay them this. And you see more mass layoffs. So then the unemployment rate goes up. So you're almost in a situation where it's like almost anything that happens leads to the same thing. And remember, what is the core of that? Well, it's moving into a completely new environment that we have not been in for the last couple of administrations, because all they've done, whether it be the Trump administration, the Biden administration, the Obama administration, it doesn't matter which one it is, they're all increasing the deficit, spending like crazy, and growing the size of the government. New guy, what's up, buddy? How you doing? So that's the main point there. Tariffs is just the thing that people talk about. And it's the first step of what they're really looking to do in order to, like, they're trying to balance a little bit of, like, trade. A little bit. So what they're doing is they're saying, okay, well, if you're going to tariff us, we're going to tariff you, but we also want to make sure that we're getting a good end of this deal as well. They could potentially bring some more revenues in. Their goal is to bring more manufacturing to the U.S., increase net exports, and kind of balance out the deficit a little bit. So it's just phase one, and that's what everybody's focused in on right now. Let's see. But yeah, guys, all right, keep smacking that like button on the way in. If you guys are enjoying the stream, costs you nothing to do it. Helps me out a whole lot spreading these streams out. Also, it is very important. Make sure that you guys turn on notifications for the YouTube channel. I'll have a good video out for you guys tonight. It's not going to be on the Fed or anything. It's just another good video. So hopefully you guys have been enjoying the video so far. It's a lot of what we've been talking about recently. And I would say right now, pre-FOMC, the bulls have it. So you have come up, shifted trend a little, made a higher low. You're starting to move back to the upside. If you take out today's high, I think that would give a pretty... That AMD is... Oh, come on, man. They really screwed us around with that one. That was rude of them. It's interesting. So, I've been good, man. I've got to move soon, which stinks. So, you guys are going to lose the view. Well, I'm moving to somewhere better, which is nice. But you guys aren't going to get this cool view anymore. But, and also, I probably have to make a studio, like an actual, like, YouTube studio now in the second room that I'll have. So, like, for me, the apartment's going to be a lot better. But for all of you guys, you're not going to get to look at the nice view anymore. So, too bad. There was another one that I looked at that had, like, the sickest view ever in Boston. It was on, like, the 18th floor looking over the water. And I was like, oh. But then as soon as I walked out of the building, it was gone. So. And it would have been like this layout too, and I kind of wanted more space. Even though this one's pretty big, it's just silly. All right. And I have a pool. I get a pool this time. We're moving up in the world, ladies and gentlemen. So, yeah, yield's moving down. This is interesting so far. This is very interesting so far. Just take a picture, make a poster. No. It's not. I mean, it's not. You guys have probably seen it before when, like, the sun is setting. That's when it's sick. Green room, paint it. I don't think I'm allowed to paint it. I'll probably get, like, sound stuff and a sign again. And I don't know. That sign that I had last time was like $500 and it broke. So, Bob is moving up a little. AMD is looking to take Monday's high out here, so anybody still in that one that made them free with short date, it's good for you. Those are looking good. Crowd's looking good. Anybody that decided to just kind of go for it on that one, those are looking good. Market's moving up here. This is looking nice. But yeah, and then if you want to join the private community too, guys, I mean, I don't say it's the best for no reason. I only have 5-star reviews. Make sure you use code TRADE. You get your first month for 50% off. It literally comes out to $1 a day for your first month, and you get access to everything. Break the rules? Yeah, but if I break the rules, they charge me a lot of money. So I'd rather not do that, you know? We're not going to be doing that. So, yeah, we've got about, what, 17 minutes here until the presser starts. We're going to get that going in a little bit. See, these should be up a lot more. I don't know why they're not. Oh, that's why. They're spready. So, we will see, team. I don't think there's anything else that's crazy coming through the feed here. Well, we got something for Nikki Leaks. Dude, Fed extends pause, revises up inflation forecast as tariff threats multiply. Get out of the textbook, Powell. Jeez, man. Get out of the book. Yeah, that's right. Stagflation. If you look at Jag's post, I mean, he's spot on too. That's what I said earlier. Remember, what did we just talk about once that data came out? Fed sees stagflation in 2025. Change in real GDP, down. PCE, up. Unemployment, up. That's not a recipe for success. It just also happens to be that they're probably wrong on inflation, so I really wouldn't get too worried about that, and that's why the market's moving up here. Like, if the Fed is going to guide towards stagflation, which is a central banker's worst nightmare, Because, guys, you can't... The only way to really get out of inflation is to cause a big problem in the economy. Because you have to get inflation under control in that case. So, like, if you had inflation running rampant, growth slowing down, and then unemployment going up, the only thing that you can do to eventually get yourself on the right track is raise rates like crazy. You just rip the Band-Aid off and go, well, we'll see what happens. There's other things you can do, but, like, that's the main one. Think about, like, Volcker. Bitcoin consolidation. I mean, I was telling you guys for a while, if you guys were watching the YouTube videos, which, again, guys, I don't make the YouTube videos for my health. The YouTube videos are for you guys, to make sure that you guys have better information than everybody else is giving you. In this range here, as long as you held above 90,700, you were fine. You could remain short-term bullish on Bitcoin, but as soon as you lost it, which is, again, what we were talking about, you're not looking too great. Then you got the strategic crypto reserve. It was literally just a break and retest of this zone and right back down. In order for me to say you're going to shift short-term bullish on Bitcoin, you got to clear back above like 94,500, right around there. So you got a long way to go. You got a long way to go on that one. There we go. We're going to hear a ding. Ding! In a second here, I think we're going to get a ding. AMD, hunting that high. Crowd hunting day highs. BABA. I like that. So here's what we're seeing, guys. The Fed, this is interesting too, for those of you guys pay attention. So when IBIT calls, if it sets up, I will be screaming in the Discord. But it's not. I wouldn't do anything on it now. Again, all those crypto tickers are going to have just like wildly crazy option chains, and they're not worth it anymore. But this is interesting. This movement, like, I don't think people fully like stagflation is really bad, like really bad. So the fact that the Fed is basically kind of not forecasting that, but like leaning towards that, like maybe being like a slightly higher possibility than before, and the market is up on that, means that they don't care what the market has to say as it relates to inflation. They don't care. They're looking at what's actually happening in the economy and what the most likely next moves are, and what's gonna in terms of like what happens with the tariffs and the actual inflationary effects, which there really aren't any right now. Growth slowing due to this new administration and their practices. Guys, if I was a reporter here, this is the question that I would ask today. XRP got some news? Yeah, it did. But that's not going to be the end all be all. I mean, we can pull up XRP here and then I'll tell you guys the question that I would ask. Yeah, I mean, I almost made a video about this talking about how it was setting up, and then I was like, I'd rather talk about other things. But yeah, that's a good one. So here's the question that I would ask the Fed. Given that you're so worried on the inflationary effects of tariffs, do you then think that there's a balancing effect with the slowing of growth due to decreased government spending and increased unemployment? Because they kind of already are guiding towards that. So I would more so focus on the actual tariff stuff, I think. I'm someone who is used to losing all the time. I can't believe I switched to your system, and for the first time, I have a solid contract. Thanks, bro. Mario, no problem, man. I mean, guys, that is the main thing that people tell me when they hop into the Discord there. It's like, I can't believe I wasn't doing this sooner. It's like, once you guys see it, you can't unsee it. I'll put it like that. You're like, oh, it's that simple? Yes. Yes, it's that simple. Stop trying to overcomplicate stuff, guys. You're not going to outsmart the PhD quant at Citadel that's running around the market here. They're not actually doing that. That's just I'm just talking there. But still, even then, you're not going to have an edge on those small time frames no matter what somebody tells you. You're just not. You will on the larger time frames, and you get to use the best edge that the market has ever and will ever offer you. Information. So, yeah, I mean, that link's pinned to the top of the live chat there. I'll throw it in the live chat for those of you guys that are interested. I am going to have something else that's fun coming out too. But, yeah, there it is. Use code TRADE, 50% off your first month. You guys will be good to go to hop in there with us. Wish you bought more Celsius. Yeah, that was an interesting one. I mean, it didn't... Yeah, that one actually did get... It's just like, you look at this setup here, it's just not great. But it did go. It definitely did go. So 10 minutes now until the presser, guys. Again, this could always get reversed, and Powell says something crazy about inflation, and then... Actually, he might get a stagflation question today. That would be incredibly interesting if they ask Powell if the Fed is guiding towards a, like... Or they're expecting a stagflationary period in the U.S. economy. Like, I agree with GDP lower, unemployment up. I just don't think I necessarily agree with inflation moving up the way that they think it's going to. Who is this guy? Hold on. Diane Swank, economist. Well, she says the Fed won't cut until early 2026. I would disagree with you, Miss Swank. Oh, no. I hope this is not true, but when asked who his favorite economist was at the Booth Monetary Policy Forum a couple weeks ago, Powell said Volcker. Oh, that's not what you want to see. That's never what you want to see there. That's not good. What do we have? One more year of Powell? Here's the other thing that's interesting. You could end up seeing a couple of these FOMC like presidents or governors coming out with an incredibly dovish stance, and what they're going to be doing is basically like peacocking to Trump to say like, hey, I'm a friend, like bring me in, I want to be Fed chair next, I'll do whatever you say. So somebody was already doing it. I forget exactly who it was. I thought it was Waller, but after his comments today, I wouldn't say it was. I could be wrong on that. So we'll see. Yeah, XRP was interesting. I mean, I might eventually, maybe next week, I'll make some more crypto videos for you guys. Yeah, and then on the videos too, or you guys can ask me now, like, if you guys want to see a video on any of those, any stocks that you want, just let me know. He has a funny way of showing it. Powell and Volcker? Yeah, I mean, being way late to raise rates, like, yeah, that doesn't really show that your favorite economist was Volcker. Good to see you, Vix. David, good to see you too, buddy. Yeah, make sure you guys have notifications turned on for the channel, guys. It is interesting because if you heard what I was talking about in the videos early on this week, I said that the Fed really had kind of every, in my opinion, even though my opinion is different than theirs is on inflation, my opinion was they had everything that they really needed to be a little bit more dovish and back off a little bit. But they're sticking to their guns on inflation. But you did see that with growth and unemployment. And I think the market is right now focusing in on that versus inflation because that's kind of yet to be determined. You've kind of already seen inflation start to roll back over. I brought it up in the video yesterday. Like, you did see end of last year in January or December, end of last year, beginning of this year, CPI print be a little high. And then it rolled over. You want me to talk about XRP? I can do that for you. It just depends, though. Sometimes you're going to love what I have to say, and sometimes you're not. That's how it is with that, like all the videos. It's like, I'm just going to give you my opinion on it. Like XRP right now after the news, that's good. But I mean, unless the market in general starts to move back up, it's not going to hold. Which right now it's holding, so. Yields down. They're buying bonds. see what else is going on Twitter. Anything good? Nah. All right. JP Morgan's Bob Michelle. This is a dovish Fed. So, I mean, I guess. I wouldn't call it dovish. Like, I would say that it's, like, in terms of, like, one side of the dual mandate. On the employment side, they're being doves. And saying, oh, we expect unemployment to go up. So then the next thing is, okay, well, then we're cut rates. But then their inflation expectations, I think, are just wrong. I think the PhDs, I want to walk in there and be like, guys, get out of the textbook. If I walked into the Fed right now and I saw everybody reading economic textbooks, I'd lose my mind. I'd freak out. Because I just don't think that they're correct. And I think the data out there in the market right now is in support of my view over the Fed's view. We'll see who's right. The Fed, I hate to say it this way, but the Fed is a pretty bad track record, guys. It's not good. Dude, I haven't talked about AMC in like 2.5 years. So you're saying my mortgage rate can come down? Why would I talk about that when it was dead? When I said it's dead, and then everybody would like, we're gonna kill you, and I was like, all right, and then their stock's in the tank, in the toilet, and I'm still alive. It's like, all right, how'd that go for you? Not well. Mortgage rates could come down if they cut, and the Trump administration accomplishes their goal of getting the 10-year down, which kind of looks like it wants to here. It's actually a good spot to short 10-year yields. Short 10Y. I'm not going to do that again. I was short 10Y somewhere. I forget where it was. I did it somewhere in here. Made some money on it. My my yen long, which was a USD, effectively USD JPY short, was nasty. I just hate that they stopped me out at break even on that thing because look where it went. I was short here. So I wrote it down basically to the 200 here, which was good. Threw a stop at break even, and they got me here. But that move down would have been so dirty. Is stagflation bearish? Stagflation is definitely bearish. But I just don't think that they're correct. Like, they can say, and they're going to get a question on this today. Oh, we got 3 minutes here. Hold on. They're going to get a question on it, and they're probably going to say, no, we don't think stagflation because, like, but that's kind of what they're saying. So, actually, let's test something really quick, just so can you guys hear this music when I do this? Hold on. Everybody get ready. I want you to tell me if you can hear this music, because I think they're going to, all right, ready? 3, 2, 1. All right, could you hear that? Can you give advice on how to pursue a year as a financial analyst after years of being out of school? No. Sorry, I'm not a... You mean like in general? Like how to analyze markets? Or like get a job at a financial firm? Because the second one, I'm not your guy. You guys heard it? All right, sick. Try it again? No. No, we're going to try it again when Powell comes on. And it'll be fine, and we're going to listen to Powell. And it's going to sound a lot better, too, than me putting the microphone next to the computer. So, that'll be good. Sweet. We still have a lot of you guys not hitting the like button. Uh-oh. I mean, sorry. Like, I can help you out with, like, how to analyze markets and stuff. Like, hang around, ask questions on the YouTube videos, hop into the private community, which I am going to have something cool coming for you guys soon, too. Maybe next week you guys will get the announcement. But it just takes time. Like, I've been doing this since forever. You just pick things up over the years. Which is why I have full confidence when I come out and say, the data's fake. That's nonsense. The Fed doesn't know what they're talking about with inflation. Like, it's not like I have reasons for this. It's not me just being like, oh, I saw it on Twitter. Let's just regurgitate it to everybody. No. That's not how it works. So, all right. 15 seconds, folks. Let's see. I want Powell. Powell's coming. Here we go. Let's see. Are we going to be able to get to 100 likes before Powell comes on? Maybe. Killer track. All right. Oh, I see him.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong overall and has made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing economic developments. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise.
It's really
as
not
the
that
outlook
uncertain.
evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. an admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly.
So they're going to be behind the
Our current
curve.
policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff,
They're telling
our
you that they're going to
securities
do it
holdings have
late. They're
declined
going to be
by
behind the curve.
more than $2
just
trillion.
So that everybody's clear.
While
on that.
market
That's not good.
indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion. Consistent with the committee's intention to hold primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet over the medium term. The committee also continued its discussions as part of our 5-year review of our monetary policy framework. At this meeting, we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Here we go.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. How much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So
Guys,
some of it,
the
answer
tariffs
is
weren't in
clearly
effect.
some of it, a good part of it.
They
is
weren't in
coming
effect
from
then.
tariffs.
So
we'll
that's
be
great work there,
working,
pal.
and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory, and that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer-term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just going to we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly because you see weaker growth but higher inflation. They kind of offset, and also, frankly, a little bit of inertia when it comes to changing something in this highly uncertain environment. I think there is a level of inertia where you just say, maybe I'll stay where I am.
Colby.
Thank you. Colby Smith with the New York Times. You just described inflation expectations as well anchored, but has your confidence in that assessment changed at all, given the increase in certain measures and the high degree of uncertainty expressed by businesses, households, and forecasters?
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully, basically every source we can find, and short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations, and people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further out, you really don't see much in the way of an increase. Longer-term inflation expectations are mostly well anchored. If you look at the New York, for example, then you have market-based, and it's the same pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys, but if you look out 5 years or the five-year forward, you'll see that break-evens are either flat or actually slightly down in the case of a longer-term one. So we look at that, and we will be watching all of it very, very carefully. We do not take anything for granted. That's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
So let's start with the hard data. We do see pretty solid hard data still. So growth looks like it's maybe moderating a bit, consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick
Timmeros of the Wall Street Journal. Chair Powell, Chair Greenspan once defined price stability as an environment in which inflation is so low and stable over time that it doesn't materially enter into the decisions of households and firms.
Can you say that today, that we have that price stability, that households and businesses are ignoring price growth? When you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic decisions in businesses and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price stability. You know, I think we were getting closer and closer to that. I wouldn't say we were at that. Inflation was running around 2.5% for some time. I do think with the arrival of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low 2s in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our policy is in a good place. We think it's a good place where we can move in the direction where we need to. But in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Edward.
Remember, the next FOMC meeting
Thank you,
is May,
Mr.
not
Chairman.
April. So
Everyone
they're going to have a
wants to
lot
Fox
more
business.
data before then. That's kind of what they're
With
looking
near 4%
at.
unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate. So you look at initial claims or layoffs, so you're not seeing people losing their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies take effect in the numbers?
Only in a kind of an early way. I mean, it's only been a few months, right? For example, the layoffs that are happening here are, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected. I think hard to trace it to specific tariffs, but it must have something to do with, it's either noise and it'll come back, and that's very possible too. But if it is persistent, then it must be to do with people buying ahead of tariffs or raising prices ahead of tariffs and things like that. Those kinds of things happen, and they're very, very hard to capture because so much of it is indirect. A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers they just kind of followed the crowd and raised it. So things happen very indirectly. And so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last?
Pandemic, yes, during the
Because you
pandemic.
could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course, we're well aware of that. And, you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy, because by the time you have your effect, you're in effect, by design, you are lowering economic activity and employment. And if that's not necessary, you don't want to do it. In real time, as we know, it's hard to make that judgment. And we're well aware, you know, of what happened, obviously, with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. You know, we haven't had real price stability fully reestablished yet, and we have to keep that in mind. And you know, we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability, and we have to balance those. And you know, there can be situations in which they're in tension, right? And we actually have a provision in our consensus statement that says what we should do in that case. That's a very challenging, you know, situation for any central bank, and certainly for us. And so what we say that we'll do is we'll look how far each of those two goals is, each of those two measures is from its goal. And then we'll ask how long we think it might take to get back to the goal for each of them, and we'll make a judgment, because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecast that really shows significant problems like that.
Well, just to follow up, yesterday, the UCLA Anderson forecast said there's a high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. It might be broadly in the range of 1 in 4 at any time. If you look back through the years, there could be within 12 months a 1 in 4 chance of a recession. So the question is whether whether this current situation, those possibilities are elevated. I will say this. We don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession somewhat, but still at relatively moderate levels, you know, still in the region of the traditional, because they were extremely low. If you go back 2 months, people were saying that the likelihood of a recession was extremely low. So has moved up, but it's not high.
Chris.
Hi, thank you. Chris Rugaber at Associated Press. As you know, I guess last night, President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I have no desire to change that answer, and have nothing new for you on that today.
Well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like, we force ourselves to look at it, but it is an outlier compared to market-based and compared to other survey-based assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless, we take notice of it.
Thank you.
Michael McKee from Bloomberg Radio and Television. There's a worry on Wall Street that when you say you want to study the net effect of the fiscal policies we may see on the economy, that you would end up waiting too long and be behind the curve in responding to any downturn. How can you
What did I say
reassure
earlier?
people that you can spot a problem early enough unless you decide to be preemptive?
Yeah, look, we're aware of we're well aware of how things are going to evolve and the timeframes and all that. And, you know, we will use our tools to foster achievement of our goals to the best we can. And, of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty. And we're watching that carefully, and we think it's a good time for us to wait for further clarity before we consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made, and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things will happen. A lot of them will happen over the course of, in coming months, certainly over the course of this year, and we'll be adapting as we go.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation. Can you walk us through what that looked like over the last couple of months, if there were specifics from the January meeting to now that helped you make those distinctions?
So when we say separating the signal from the noise, that's just a way of saying that things are highly uncertain, and that, you're reading about developments of tariffs being put on and taken off and things like that. Some of that is noise in the sense that it's not really telling you anything. You're trying to extract a signal from that, and the signal is what's going to be the effect on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second thing was?
Or similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. The idea being, and I do think that the first 2 months of this year are a great example. You've got high readings for goods inflation after a string of readings that average close to zero, and you have to ask, it's coming during tariffs, but you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories, which will shortly reverse, and that happens too, and that could be a big piece of it. I think we'll know. In a couple of months, we'll know whether those were, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else, and we'll all be trying very hard to make that assessment. And I'm sure we will make a lot of progress on that, and we already have. But it's going to be a challenge.
Do you have a sense yet as to what, in your mind, would make something cross from noise to a signal, what that threshold would look like?
It would depend on what we're talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if something that was, in the service sector that was far away from anything that's tariffed, you might think, okay, well, that is, like, frankly, housing services inflation, which, by the way, has been behaving well, which for some time was kind of our problem. Now it's slow, but it's definitely, moving down in a very good way. It's more now with goods and to some extent with non-housing services inflation.
Kelly.
Thanks for taking our questions, Chair Powell. Kelly O'Grady, CBS News. So consumer sentiment has dipped dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not wrong to be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment is high. It's none of those things. We have, 4.1% unemployment. We've got 2% growth, and it's a pretty good economy. But people are unhappy because of the price level, and we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer? Does that mean you see a slowdown in economic growth as a real threat?
So I think remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth but higher inflation. And they kind of balance each other out. So you think, and unemployment is there's really only a 1/10 change. So there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for different responses, right? So they cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in through the reserve banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully. So I would tell people that the economy seems to be healthy. We understand that sentiment is quite negative at this time, and that probably has to do with turmoil at the beginning of an administration that's making big changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how the debt ceiling, raising the debt ceiling, might affect the reserve supply?
Yeah, so in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not. But some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. You know, it's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. And of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked, if they're not so well anchored, why hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much, I mean, if at all. There's one reading that everyone's focusing on that it's higher, but the other survey readings and the market-based readings all show relatively, well-anchored inflation expectations. You would expect that expectations of inflation over the course of a year would move around because conditions change. In this case, we have tariffs coming in. We don't know how big, what's speed. There's so many things we don't know, but we kind of know there are going to be tariffs, and they tend to bring growth down. They tend to bring inflation up in the first instance. So I would say, I'm not dismissing what we're seeing in short-term inflation expectations. We, as I mentioned, follow that very carefully. But when we say expectations are well anchored, we're really looking at longer terms, 5-year and out, and there's really no story to tell 5 years and out, either in market-based or in surveys. But we'll watch it. I mean, we're not we're not going to miss any evidence that longer-term or medium-term inflation expectations are moving.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been moving in a healthy range. I mean, they're all jobs, but and remember, we're at very low unemployment for quite a time now. So I think it's a good labor market, but it's something that we monitor carefully. From our standpoint, employment is employment. But the elected government is entitled to have, we don't have policies that address different kinds of employment, but the elected government has a different role, and they can have those.
Can I do a quick QT question? Does the committee envision at some point tapering the MBS runoff as well?
I think tapering it, I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. But, we want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned, or is that one more thing that you're uncertain about?
I'm confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move. I don't know anyone who has a lot of confidence in their forecast. I mean,
guys, those are alerts going
off.
We're
at a
place
it's
really
where we can
not,
cut, or we can hold what
how do
is
you guys
a
not
clearly
know
restrictive
this?
stance.
You guys don't
policy.
set trading view alert? You guys need to get
That's what I mean.
I don't know.
I think that's well
how
positioned.
are you going to know when things are firing off? You guys
right
wait
now
for
is,
other people to tell you when to trade?
always
Come
very,
on,
very hard,
that's crazy.
And,
all right, let's get back
in
to
the
that.
current situation. I just think uncertainty is remarkably high.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
Matt.
Matt Egan with CNN. Thank you, Chair Powell. The Fed statement released today removed a line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. That was useful as we approached liftoff, if you remember. But we're past that. Or sorry, no, beginning to cut. So we just took it out. I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look, participants widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us because, financial conditions are the main channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. The real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent with full employment, 4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Inflation, underlying inflation is still running in the 2s with probably a little bit of a pickup associated with tariffs. So I don't think we're facing, I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter, so I'm gonna pass on that one. Thank you.
Daniel.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of retaliatory tariffs from other countries, especially with April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those. And so that's kind of baked into the numbers. What happens, it will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
Hi, Chair Powell. Jean Young with MNI Market News. Had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. It slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account flows, that got us thinking about this. But the more we thought about it, we came around to this. And it is, yes, it was provoked. The original discussion was provoked by that. But I think what we came up with, though, was broader than that and different than that. It does address that issue, but it really is also, it fits in really nicely with our principles and our plans and the things we've done before and the things we said we would do. So that's why, pretty strong support. I'd just say it's nothing to do with monetary policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
Alrighty, ladies and gentlemen, that was pretty wild. So they're sticking to their guns on inflation. They basically said that those inflation expectations that came out in that what was it, consumer sentiment number were a wild outlier or anomaly. Yeah, obviously, guys, they were projecting inflation for the year end to be 4.9%. That's insane. So, all right, team, that's gonna basically wrap up today. You guys are trying to do something crazy today. I mean, that's a pretty silly way to operate in the market, but. Again, for those of you guys that want to really take full control of everything that the market has to offer and join what I would say and what all of the members would say is the best trading group out in the market right now. I mean, here is the link to it. Use code TRADE. You get 50% off your first month there, guys. Again, you get both the educational courses, the private live streams every single day, which we're going to do today. Fed day. Why are we doing it today? The full watch list of stocks and cryptos that are about to explode before they do, the pre-market plans, the macro research reports, single stock research reports, everything. So, again, all of that that's in there, guys, is going to give you guys the tools to have long-term success in the market. It's just up to you if you really want that. Do you really want to have success in the market or not? So that's up to you.
This further recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we move toward a more neutral stance over time. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing policy restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook.
Hold on. It went to another. Hold on. How about now? You guys should be good now. Oh, I mute. Oh, if I mute it, you can still hear it? Oh, that's interesting. I didn't know that. You can definitely hear me right now. You should definitely be able to hear me right now. Powell's still playing. Now, you guys can definitely hear me. You guys are messing with me here. Good now? Corrected? Oh, yeah. Sorry about that, guys. So, yeah. Again, I'll throw the link in there to the Discord again. I mean, you guys kind of know the deal for it. I am going to cut off that code, though, next week. So there's going to be no more 50% off your first month code next week. I'm just going to be done with it. You guys have had enough time to come in. You guys have seen all the epic trades that I've given out. And the way the market's looking right now, guys, it looks like it's going to be absolutely epic in the near future. But I'll see you guys later. Make sure you guys are ready for that YouTube video tonight. I know a lot of you guys are really going to enjoy this one. But until then, I'll see you guys in the video. I'll see all of you guys in the Discord on the live stream tomorrow morning. Other than that, peace.